Hello all. Welcome back again to another lecture. So today in the world of risk, we are going to learn about one of the most important topics in risk management and a very frequent topic that is asked in any interviews or exams wherever you go in a risk management domain. So let's get started. So today we are going to learn about enterprise risk management or commonly known as ERM. So I think many of you have heard about ERM. So let's quickly dive today into it and see what ERM is, what are its components, and why it is established. So what is ERM? So as we know that risk management has a very long history. Basically, it origins back to like 1920. So over time, people have developed many risk management approach, and one of those developments have led to this ERM or enterprise risk management. So what is it? It is a comprehensive approach that organizations use to identify, assess, manage, and monitor risk. So this is kind of combination of everything into risk management. So this involves integrating the risk management practices through all the levels of organization to create a unified framework for addressing risk strategically. So what does this mean? We will come to this in a different slide. So for now, just remember that ERM is a comprehensive approach where risk identification, assessment of the risk, management of the risk, and monitoring of the risk is done. Now, why ERM? So, as I told you, from 1920 onwards, risk management was present and we were trying out new risk management techniques. So, these traditional risk management techniques involved mitigating risk within business units. So, let's say there is an organization with five business units, like say finance, operations, marketing, HR, strategy. So, what the traditional approach did was they used to mitigate risk within each department. So operations would mitigate their risk, marketing would mitigate their own risk, say HR would mitigate their own risk. So kind of this was done within this business unit. Now what happened is this was non-comprehensive way where the risk appetite was not shown overall. Now this led to gaps in risk management and a clear picture was not seen. So I as a investor or say I as a third party or say I as a top management will not have the complete look of the risk of my organization because it was different within different organizations. So this led to the development of enterprise risk methodology. So what after the ERM was implemented, organizations can better understand their risk appetite and improve decision-making capabilities, prioritizing initiatives and mitigating plans. So after ERM was implemented, these independent risk management or mitigation was abolished and an enterprise level risk mitigation strategies was present. So you might have seen in your organization or any of these whenever you are working in the banks or any organization, you have seen that you are getting certain modules to complete. So these are common across the organization. Why? Due to the ERM. So let's move on. So the components of ERM, we'll quickly go through it. If you need a detailed explanation, do let me know because each component is a chapter in itself. So the first thing would be the company culture, governance and value. As its name suggests, culture, governance, structures or the values of an organization will play a major role in establishing the enterprise risk management program, like the internal policies, procedures, code of conduct, team norms, or operational norms. business unit view of risk, how they view risk. So these come under this. The next is the strategic planning. So this is basically done from a strategic point of view. Like it will be a top-down approach. It comes from the higher management, then it flows down to the middle management and to the lower management. So this is where goal setting, the objectives of the company or what for this year, what they are going to do are set. Then we have the risk management cycle. So once this senior management has set the goals and everything, so this cycle begins where identification of the risk is done, assessment is done, response starts. So these kind of things start with this risk management cycle. Now monitoring and continuous improvement. So once these risks are identified, right? So they will be doing code, they will be giving points, factors, color codes, everything to this risk, and then they will define which is what kind of risk has been identified. Like say financial risk is identified, operational risk is identified, or say cyber risk is identified. Once this is done, the monitoring is started on this risk, and then improvement, how this risk can be improved or the process can be improved, this is done. The next thing is the transparency, communication and reporting. So as its name suggests, we need to be very transparent within all the organization that this is the risk, this is the way how we are going to mitigate. This needs to be communicated across the organization. It is not like that the CEO or the top management has decided we will do these things and they are keeping it to themselves. No, this has to be communicated within the organization so that comprehensive risk framework should be developed. And then reporting, if any deviations or anything is seen, we need to definitely go ahead and report it via the established rules. Also, the organization needs to report it to the authorities if any deviations are seen. So these are the few components of ERM. Now ERM standards. So this is a very, very important question when it comes to interviews. So they ask what are the standards that are implemented in the ERM. So this is a quick view. Like there is the ISO 310002018 standard. There is the IRM, LRM, AIR, MIC 2002 standard. Then there is the ISO IEC 31010 2019 standard. Then there is the COSO 2004 and 2017 standard. So do remember these standards are very comprehensive. Go through it. If you need any help, if you want to make, let me know if you want to make me any videos on these standards. I'll definitely go ahead and do. Now, once the risk is identified and everything is done, there are basically four risk treatment methods. So I'll quickly go over those. The first is risk mitigation. So organization here address the risk with controls and processes to limit the impact. So they have identified, they will tell, oh, we are going ahead and mitigating it, and they will come up with controls and so that it limits the impact or reoccurrence. The next is risk avoidance. So they will tell that let's not move forward with the decision that we have taken, or let's not invest in this opportunity or open this market. So this kind of, they will avoid the risk. The next is the risk transfer. This is generally what we all do. We'll take up an insurance or we'll transfer it to a different department. In case of huge organizations, or special purpose vehicle is created to transfer the risk into it. So this kind of things is that where the organization is safe and the risk is transferred. The last is risk acceptance. So they know that there is no way to go ahead and be safe from this risk. Let's embrace it. This is done only and only when the risk impact is very low, very, very low. Say you are losing only say $1 or say 1 rupee out of 50 billion investment or 50 crore investment, then maybe we'll go ahead and accept the risk. So remember, for risk acceptance, it should always be the last option and the impact should not be big. Now we saw COSO and ISO. So these are two organizations, the Committee of Sponsoring Organization of the Tradeway Commission and International Organization for Standardization. These two are the committees, or basically you can say the makers of the ERM practices. So they will make ERM practices for the organizations, and we need to follow them. So guys, this is it for today. And a big thank you to all of you. We have reached 445 subscribers. Please keep subscribing and please keep watching. Thank you.